All right, today we are diving into a really fascinating puzzle in the gold mining world, Newmont Corporation. We're going to try and figure out how different analysts can look at the exact same company and come up with valuations that are just worlds apart. Let's get right into it.
And I'm not kidding when I say worlds apart. This is the big question for today. How is it possible that one group of experts looks at Newmont and says, yep, that's worth $40 a share, while another group, using a different crystal ball, says it's worth $220? I mean, that's an insane disagreement, and the answer tells you something really important about how these gold miners actually work.
Okay, so this chart just lays out the puzzle perfectly. On the far left, you've got the conservative net asset value. You know, what the company's stuff is worth minus its debts. And that's pegged at just $40. Then, right in the middle, is where the stock is actually trading today, around $120. But look all the way to the right. That's the valuation if you believe today's high gold prices are the real deal, a massive $220. The stock is literally caught between two completely different realities. So what's going on here?
Let's start with the bear case. This is the world as seen by the really cautious, value-focused analysts. They're basically asking one simple question. What if this whole high gold price party ends and things just go back to normal?
So this is what's under the hood of that conservative view. The model assumes a gold price way down at around $2,050 an ounce. It also plugs in Newmont's cost to mine that ounce, what they call the all-in sustaining cost, or AISC, at about $1,620. And here's the kicker. With a lower gold price, that profit margin on every single ounce they dig up gets squeezed. Big time.
And when you run those numbers, you land at just $40 a share. So from this point of view, Newmont's current price of $120 looks incredibly expensive. This is exactly why the analysts who don't buy into the high gold prices forever story have been staying on the sidelines.
Now let's flip the script completely and look at the bull case. This is the world where today's high gold prices aren't some fluke, they're the new normal. It's the momentum view, right? Valuing the company based on what's happening this very minute.
The assumptions here are a whole different ballgame. This scenario plugs in a gold price around $5,000 an ounce. Instead of looking at old averages, it just takes Newmont's huge annual production and multiplies it by today's amazing profit margins. And the key driver, the thing that really juices this scenario, is the company's massive production volume per share. Now hold that thought, because that is the secret to this entire puzzle.
And when you do that math, the valuation just explodes to $220 a share. So, if you're in this camp, Newmont isn't overvalued at all. It's trading at a massive discount, maybe 50 or 60% of what it's actually worth. So you see, we've got two totally logical but wildly different outcomes. What on earth explains that swing?
Well, this brings us to the heart of the matter, the leverage engine. This is the mechanism that explains why Newmont's valuation can swing so violently between these two futures. It's the reason you'll hear people call it a high-octane trade.
The magic words here are operational leverage. For a gold miner, this is basically a measure of how much its profits get amplified for every single dollar the price of gold moves up. And the secret ingredient, the thing that makes this leverage so powerful, is how much gold the company produces per share.
And boom, here it is. This is the aha moment. Let's compare Newmont to its biggest rival, Barrick Gold. For every single share of Barrick stock you own, the company digs up about 0.0022 ounces of gold. But for every share of Newmont, it's 0.0053 ounces. That is more than double. This right here is the source of that crazy leverage.
So what does that actually mean? It means this. Because Newmont produces so much more gold per share, its earnings are like they're on steroids when gold prices rise. Every $100 jump in the price of gold adds about twice as much cash flow to a single share of Newmont as it does to a share of Barrick. That's the leverage engine firing on all cylinders.
Okay, so now that we get the mechanics, let's put these two giants head to head. Because this isn't just theory, it leads to two completely different ways to think about investing in gold.
This table just wraps it all up so nicely. You can see the share prices and the NAV ranges we've been talking about. But check out those last two rows. Barrick's strength is its cost stability. It gives you better protection if things go south. Newmont's strength is its volume leverage. It gives you way more upside. And this has shaped how the market sees them. For Barrick, it's a show-me story. People are skeptical. But for Newmont, it's a believer story, a pure momentum play on high gold prices.
And this gives you, the investor, two very clear paths. If you want relative safety and a stock that might be a good value even if gold prices fall, you might lean towards Barrick.
But if you're a true believer that gold prices are going to the moon and you want the most explosive ride up, well, then you go for Newmont.
Which brings us right back to this quote, which is just the perfect summary. Newmont really is the high-octane trade. It's a leveraged bet on the price of gold, plain and simple, and it's built to give you massive returns if, and it is a big if, those high gold prices stick around.
So, that solves our puzzle. But it does leave us with one last really interesting question, doesn't it? If a giant company like Newmont is considered the high-octane choice, what in the world does that make the smaller, so-called junior miners in this space? Well, that sounds like a question for another day. Thanks for joining me.